SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Good afternoon and welcome to this SUERF-BAFFI Bocconi webinar. For the last 50 years, the US dollar has been, as we have all observed, the world's most important reserve currency. This feature, also known as the exorbitant privilege, is best illustrated by the role of the US dollar in international trade and portfolio management. In parallel to this importance of the currency, also the US Treasury market has provided the world's safe asset and the main measure of the global risk-free rate. Both of these markets are very deep and liquid. So in any stress episode, we have seen that they often provide the global safe haven for investors. Recently, however, the relevance of these two core instruments, really highly systemic instruments of the international economy, has faced a number of major challenges. In particular, as we are reading in the newspapers on a regular basis, there is now a strongly changed political climate in the US. We have geopolitical frictions and, last but not least, quickly rising debt issuance in the US. For instance, the US debt to GDP ratio is now above 125%. So financial markets have started to react to these changes in the macro environment, and the pricing of US safe assets has been adjusting for quite some time. Any changes in the valuation of core US instruments have major repercussions across the financial system, and so raise many questions for policymakers and for investors. For this purpose, we have brought together a very distinguished group of colleagues from academia, from international central banking and the private sector. In particular, we are very happy that Wenxin is joining us today. She will share with us her observations from a comprehensive and very detailed analysis of the US dollar and the Treasury market valuation and its broader implications. I will now hand over to Cornelia to start the panel and introduce our speakers for today.
Thank you very much, Martin, and welcome to the seminar, which I have the pleasure to host for today. It's a great pleasure to have a really highly distinguished colleagues here today. First of all, Wenxin is our main speaker. She's the Sylvan C. Coleman Professor of Financial Management at Harvard Business School. Her research focuses on global currency and fixed income markets, central banking, financial regulation and fixed income markets, central banking, financial regulation, and fintech. So really very broad portfolio. Her work on deviations from covered interest rate parity has earned the AQR Insight Award top prize. She has also served as a financial research advisor at the Federal Reserve Bank of New York, principal economist at the Federal Reserve Board, and central bank research fellow at the Bank for International Settlements. She is a research associate at the NBR and holds a PhD in economics from Harvard University. Thanks for being with us today. Now let's come to the two discussants. Andreas is our discussant from the central banking community. He's head of financial markets in the monetary and economic department of the BIS. He has an extensive track record and policy relevant research on the role of intermediaries, exchange rates, and the intersection of monetary policy and financial markets. Prior to his current position, he served for several years as secretary to the Markets Committee. Andreas's work is published in leading academic journals, including the Journal of Finance, Review of Financial Studies, or Journal of Financial Economics. He's also a CEPR research affiliate. And then finally, Zornitsa, she's our discussant from the private sector. Zornitsa leads the Thematic FICC research team at Barclays. She's based in London and covers topics such as market structure, innovation in financial markets, and emerging macroeconomic trends. And prior to joining Barclays, she taught risk management and investments at Bocconi University. She holds a PhD honors degree from Bocconi. So we can start with the presentations now. I would hand over to Wenxin for a 45 minutes roughly presentation. So please, Wenxin, the floor is yours.
I hope everybody can see the slides.
Yes.
Thank you so much for the invitation. I'm going to be talking about the dollar and the Treasury privilege today. This is joint work with Reed Kirati at the Federal Reserve Board and Jesse Schreiger at Columbia Business School. Okay, so as we know, the special role of the US dollar and the US Treasuries are defining features of the international monetary system. People tend to associate these two concepts very closely. In general, we believe the US dollar is special because the US Treasury market is one of the deepest financial markets in the world. And also conversely, we think US Treasury is special because it is denominated in US dollars. In this paper, we're going to challenge this view and to document a significant divergence between these two forms of privilege. In particular, we are going to show that there has been a continued positive convenience on the US dollar. In other words, the US dollar remains to be very special, both throughout the global financial crisis in 2008 and 9, and also in the aftermath of the crisis over the past 2 decades. In the meanwhile, we are going to document a significant negative convenience yield or inconvenience, if you like, associated with the US Treasury securities. We are going to argue that the government bond supply and intermediary constraint post-global financial crisis have been significant drivers of the inconvenience associated with US Treasury. Okay. So I am first going to be talking about the measurement and the data, and then we're going to be looking at the empirical results together. So a big part of this paper is to propose measurements for these two forms of convenience, the convenience of US dollar funding and also the convenience of US Treasury security. So when we measure US dollar funding convenience, we are going to be using this measure called covered interest rate parity deviations and applying those deviation calculations to the risk-free bank rates. The idea is we can calculate this X with superscript RF, which denotes the risk-free rate, as the difference between the FX swap implied dollar risk-free rate measure and the actual cash market, dollar money market risk-free rate measure. So let me take a couple more minutes to explain what this measure actually does. So if we think about it, there are risk-free rates. Think about money market rate benchmarks in all different currencies. If you take a euro risk-free rate, you can use the FX derivatives to take care of all the currency risk and to transform this risk-free bond into a dollar-denominated risk-free bond. And that's what we capture in this first term, okay? So if you take the foreign currency risk-free rate denominated in subscript I, subtract off this forward market implied FX risk premium, so you get the FX implied dollar risk-free rate. And then you subtract off the more generic dollar risk-free rate from the US dollar money markets. So if this X measure is positive, we argue that the US dollar is more convenient than foreign currency. Why do we say so? This means investors are willing to forego additional returns on holding this generic dollar risk-free rate rather than the synthetic dollar risk-free rate. Conversely, if X superscript RF is negative, we argue that the US dollar funding is less convenient than foreign currency because the second term becomes larger, which means investors need to be incentivized with additional return on holding the generic US risk-free rate as opposed to a synthetic risk-free rate, okay? So that's the idea of the convenience yield measurements on the US dollar funding. So what would be the right risk-free rate benchmarks for us to use in all these different currencies? So prior to the global financial crisis, what we have been using is LIBOR, or London Interbank Offer Rate. So LIBOR continued to be used as a risk-free rate and also after the global financial crisis, but there are many drawbacks of LIBOR. For instance, LIBOR is indicative. It is not based on actual transactions for most of these markets, and it's also unsecured. So if we were to use LIBOR to construct risk-free rate-based CIP deviation and hence US dollar convenience, you might be concerned that this measure is clouded by all these money market frictions. The good news for our measure is that since 2022, many major markets have adopted alternative benchmark interest rate measures. And these measures, such as the secured overnight financing rate in the US and in a few other countries, have significantly reduced the credit risk. And also these new floating rate benchmarks are able to more accurately represent actual transactions. So therefore, after the post-benchmark reform, we are going to be using these alternative risk-free rates as our measure of US dollar funding convenience. Overall, we find that using these alternative, more repo, more actual transaction-based risk-free rates, we are actually going to modestly boost the US dollar convenience measure, which suggests that whatever LIBOR-based convenience measure you observe in the past are not merely due to frictions in the US or other foreign money markets. So I can show you a couple of quick charts just to highlight this comparison between LIBOR and the alternative money market benchmark-based CIP deviations. So what you see here is the red is the alternative benchmark-based US dollar convenience, and the blue is the old LIBOR-based US dollar convenience. So for all these 5 developed markets plotted here vis-a-vis the US dollar, 4 out of the 5, we have the red line above the blue line, suggesting that the alternative benchmark measures such as SOFR and their foreign counterparts are associated with higher US dollar convenience measure. Canadian is the little bit of the outlier here. Okay. We can use the very similar logic to measure the US Treasury convenience, whereas here, instead of using the benchmark risk-free rate formed from these money market transactions, we are going to be using the government bond yields across different currencies and in the US dollar. So very similar construction as before. We are going to be measuring the US Treasury convenience. This is the relative convenience relative to other foreign currency government bonds as the difference between the swapped foreign government bond yield expressing dollars and the US Treasury yield also expressing dollars. So if we take German bond, say 5-year, we use a cross-currency swap to take care of all the euro-denominated cash flows and to swap and hedge them into dollars, then we essentially transform this euro-denominated yield on the bond into a synthetic dollar-denominated yield on the bond, and then we compare this implied dollar synthetic yield on the bond with the 5-year yield on the US Treasury. So same directional definition. If this X is positive with superscript gov, we say that the US Treasury is more convenient than foreign government bonds because, again, investors are willing to forego some additional yield to hold this lower yielding generic Treasury as opposed to be a synthetic dollar-denominated bond issued by the federal government of Germany. And on the other hand, if X superscript gov is negative, that means US Treasury is less convenient than foreign government bonds because now investors need to be incentivized with additional return in holding the generic Treasury as opposed to swapped foreign government bonds. So throughout this talk, when you see a positive X, you're going to interpret it as US dollar relative convenience relative to the foreign currency or the foreign government bonds that you're comparing. And the superscript is going to denote whether we are referring to the government bond convenience or the US dollar funding convenience. Okay, so that was the methodology in terms of our measurements. In terms of the data, we construct a data set which is now available on our website, so you can download them if you like. That consists of the government bond yields and the money market rates and interest rate swap rates for 10 developed markets. These are referred to as the G10 currency areas and also 18 emerging markets. So within the 10 developed markets for the euro area, we are only going to be using German yields and yes, so German government bond yields. We do not include any other euro-denominated bond yields from other countries in the euro areas. And as you can see, for emerging markets, we focus on the group of more major emerging markets. These are countries with a more established local currency government bond yield curve and also swap markets, both interest rate swaps and cross-currency swap markets of modest, relatively decent size. The sample period began in January 2000, and our most recent update ended in June 2025. We hope to be able to continuously update this data so that researchers can download them and use them in your own research. In this version of the data set, we have the full spectrum of tenor running from 3 months all the way to 30 years. And as we discussed, you can also look up our website for the Bloomberg tickers in terms of how these measures are constructed. Okay, so now I'm going to show you some empirical results on this very pronounced divergence between the USD, which is US dollar, and the UST, which is US Treasury privilege. Okay, so let's first look at the short-term maturity. So here I have 2 lines. The right line is the government CIP deviation, or X superscript Gov. This is the relative convenience of US Treasury bill relative to the G10 developed market bill average. And we also have the blue line, which is the benchmark CIP deviation. This is the X superscript risk-free rate, or the US dollar specialness, okay, at 3 months maturity, again, measured relative to the G10 currency average. What do you see here is that before the 08-09 global financial crisis, this blue line is roughly 0. So CIP deviation was near 0 for G10 currencies. What this means is that prior to the global financial crisis, it didn't seem dollar in terms of dollar funding, or the difference between synthetic dollar versus the actual dollar, that difference was fairly negligible, which is consistent with the fact that the risk-free rate-based CIP deviations is a textbook no arbitrage if they exist at scale more persistently, and if financial intermediaries were largely unconstrained, they would step in to arbitrage the basis away. By contrast, what you see is actually a significant premium or convenience for the 3 months US Treasury bill compared to the G10 government bills, because the red line, despite the blue line being 0, was fairly positive before the global financial crisis. Both measures increased significantly at the peak of 08-09 crisis, not surprisingly. And after the crisis, they first co-move for a significant chunk of the post-crisis sample, but more recently, over the past 2 to 3 years, you've seen significant divergence. That the 3 months bill, the US dollar's 3 months bill, are no longer as convenient. This red line has dipped to close to 0 or even negative territory, despite that the US dollar funding short term remains quite special. Okay, so that's the facts for the short term. But if you look at the longer term, the story is quite different. What you see is a lot more pronounced divergence between the specialness of long-term US dollar funding. Here we're looking at the 10-year US dollar funding privilege as plotted in the blue line, and the 10-year US Treasury specialness or privilege as plotted in the red line. So what you see is that despite the US Treasury were special before the global financial crisis, this specialness has been largely declined and disappeared soon after the global financial crisis. And there has been a remarkable secular decline if you zoom out of these more high-frequency fluctuations. And in the meanwhile, the specialness of long-term US dollar funding continues, as shown in this blue line, which has always been above 0. Okay. And so far, I've been discussing this comparison between US and the average G10, the average developed market currencies or government bonds. You can also, so I'm going to cover the term structure first, and then we can look at a bit more emerging markets. So far, I showed you the 3 months and the 10-year. This picture shows a bit more granular term structure, going all the way from 3 months to 30 years. So the story is that after the global financial crisis, the short-term Treasury bills remain special for quite some time. We're talking about the 3 months and the 1 year, whereas the long-term Treasury bonds have lost their specialness pretty soon after the global financial crisis. But overall, you truly have observed a secular decline in the relative US Treasury specialness across all maturities, compared especially to the pre-crisis world, when at every single maturity, the Treasury bills and bonds were quite special. So that gives you the full term structure idea. And as promised, I'm also going to show you some results on the emerging market comparison. So what this chart shows in the red line is what we have seen before. It's the 5-year US Treasury specialness relative to the G10 government bonds. But we also have a blue line here, which is the specialness of US Treasury relative to the average 18 emerging market government bonds. So here, one note that this particular measure of US Treasury convenience, when you compare with emerging markets, can also include additional risk. That's not just about the convenience, because emerging market bonds have credit risk, right? We know most of the sovereigns that we have in our sample are not AAA rated, so sovereign risk can be quite considerable. And in addition, many countries also impose some form of capital controls. So you would expect when global investors invest in emerging market government bonds denominated in local currencies, the pricing of these bonds need to reflect these additional risk, and therefore these additional risks should also be reflected in the blue line. So even after incorporating, in theory, all these additional risks associated with emerging market government bonds, what we have seen is that the US Treasury premium measure relative to emerging market government bonds has become very, very modest. So it has declined, and over the recent 2 to 3 years, it has been below 50 basis points, which is also quite a remarkable development. In addition to this significant decoupling in the level of the privilege, what we can also estimate is to see if there's any disconnect between the beta or the risk characteristics of these types of privileges. And what we are doing here is to run a very simple regression of changes in these premium measures or specialness measure on the change in this proxy of global investor risk appetite, or the change in VIX. What we have found here is that if you look at the red line, which shows the beta of the US dollar specialness loading on VIX, and also the blue line, which is the beta of the US Treasury specialness loading on VIX. And we also, in this chart, plot the green line, which is the beta of the broad dollar exchange rate. This is unhedged on VIX. So the story you see is that all these three measures of beta or risk exposure to VIX have a positive beta. A positive beta indicates that these are the hedging assets, because the premium goes up when VIX goes up, and premium signals US dollar specialness. This green line gives you the indication of a broad dollar appreciation. So a positive beta also denotes that when VIX goes up, in general, the broad dollar appreciates. So betas are all positive in the first half of this post-crisis sample before 2015. And then beginning 2015, you also see divergence in the beta between the government bond CIP or the US Treasury specialness away from the dollar-based beta, and both in funding and in the spot exchange rates, right? You see that the green line and red line remain positive despite being slightly smaller compared to most recent history over the past few years. Still, we see that when VIX goes up, on average, the broad dollar appreciates and the US dollar funding specialness measure increase. However, when VIX goes up, what you see is that the US Treasury specialness measure declines, and that pattern is fairly pronounced, I would say, over the past 5 years. What you can also do is you can do these scatter plots for each types of beta across the two sample periods. On the x-axis, what we are showing is the beta estimated from 2010 to 2015 subsample, and on the vertical axis, we show the beta that's estimated between 2021 and 2025 sample. As you can see, for the dollar exchange rate and the benchmark CIP deviation or the US dollar funding specialness, the most recent sample have a little bit of a lower beta, but still the beta lines up in the positive territories for both subsamples. Whereas the government CIP deviation panel C on the right, or the US Treasury specialness, you see that most of these currencies, not just on average, right, for each of these bilateral calculation, you see that the beta have been largely negative in the most recent 5 years of sample. So not only the US Treasury specialness on average doesn't look like a hedging assets anymore, it's fairly risky. And also bilaterally, when you are evaluating this measure vis-a-vis pretty much all these G10 countries, you also see a negative loading, which means it's a risky spread measure with respect to VIX. Okay, so that's the fact part of the paper. And I can't just stop here, right? Because you're going to ask why. What explains the significant divergence between the US dollar and the US Treasury privilege? So that's what this part of the presentation is going to be, hopefully shed some lights on what we think are the key drivers. In order to understand the divergence of the US Treasury specialness away from the US dollar funding specialness, I'm going to first do a decomposition of the US Treasury specialness. This is a counting identity, so it has to hold, but by breaking down this US Treasury convenience measure into 3 terms, it helps us to think through what each term is actually playing, what type of role they're playing in driving this overall secular decline in the US Treasury specialness. Okay. So the first term in our decomposition is the US dollar convenience measure. So this is to say, because Treasury is denominated in dollar, if dollar funding is special, that should reinforce the specialness of US Treasury. Okay, so think about dollar Treasury CIP is going to be decomposed into the first term using the risk-free CIP deviation, and that is exactly our US dollar funding convenience yield measure. But Treasury specialness is not equal to the US funding specialness. Why? Because the relative spreads between the Treasury yield and the risk-free rates in all these currency areas may not be equalized. So if you do a relative comparison between US and foreign currency, what you are essentially comparing is the difference between the swap spreads between the US and foreign countries. So what is the swap spread? The swap spread is defined as the difference between the risk-free rate in the local currency and the government bond yield of the same currency at the same maturity. Okay, so what we see here is that the second term gives us the US swap spreads. So you have a subscript dollar sign in both terms. And then the third bracket gives us the foreign swap spreads. So if we have a deterioration in the US swap spread, that means the US Treasury yield is priced pretty high compared to the US dollar risk-free rate. That's going to be acting as a drag for the US Treasury convenience. So thinking intuitively, okay, US dollar risk-free rate is so special, that's captured in the first term. But if Treasury is not so special at all relative to the US risk-free rate, and that could be a drag that reduces the desirability or the specialness of US Treasury. We also have this final term, which is the foreign swap spread, which works in the opposite direction as the US swap spread, because this whole measure is a relative measure, right? So, if foreign government bonds, again, are not so special at all relative to the foreign risk-free rates, that should boost the relative specialness of US Treasury. Okay, so in other words, the US swap spread enters positively into this expression for the US Treasury specialness, and foreign swap spread enters negatively in the expression of the relative US Treasury specialness. So after this decomposition, we can just look at some summary stat numbers across different periods for these different components. So the top line shows the overall results for the decline of US Treasury specialness, right? What you see is that over the past 5 years in particular, now on average, we have 26 basis point negative convenience. And During the same time, what you have seen is actually additional reinforcement of the US dollar funding specialness. You see that in this last column, now the US dollar specialness is actually plus 20 basis points, roughly speaking. So what is going on? It has to be that the US Treasury, the US swap spread is acting as a significant drag, and that's indeed the case. You see that the swap spread at 10-year maturity soon after the global financial crisis was slightly positive at 6 basis points, and now is in a very deep negative territory at minus 26 basis points. So the 30 basis point decline from the first column to the third column acts as a direct drag in bringing down the specialness of US Treasury securities. And finally, for foreign swap spreads, there's also a decline around 8 basis points, but the decline in the foreign swap spreads over the sample is much more muted compared to a much sharper decline in the US swap spreads. So to recap, just from this accounting point of view, what is the most important drag of US Treasury specialness? It is the relative perception of Treasury inconvenience compared to the risk-free rate in US dollar. It's from the US swap spread term. And another way to say it is that despite the vast boost of US dollar specialness in more recent years and in post-GFC in general, the deterioration in the Treasury specialness relative to risk-free rate more than offsets this additional increase in the US dollar funding specialness. Okay. So that's the accounting, which is not the most satisfactory explanation because it just tells you what must have happened. In terms of what actually has happened from an economic point of view is I do think it's important to highlight this following picture. So what we are seeing is a significant increase in the supply of treasuries. Both measured in terms of total marketable treasury outstanding, as shown in this red line, and also if you want to take out the amount of treasuries held on the Federal Reserve's balance sheets, you end up with the orange line. So both the red line and the orange line have experienced a kink after the global financial crisis, and also a little bit of a second kink after the COVID pandemic. If you plot these two lines of treasury supply against this one proxy of intermediary constraint, which is the total assets of the broker-dealer sectors in the US pool of funds, you have this very significant contrast between this big increase in the supply of treasury securities and the overall much more muted footprint of the financial intermediaries. So broker-dealer total assets significantly outpaced the supply of treasury bonds before the global financial crisis. But post-crisis, as you can see, after the collapse of Lehman, the total assets of the broker-dealer sector have maintained fairly stable in dollar amounts, only until very recently finally caught up the level, the peak achieved at the Lehman pre-global financial crisis. And this by no means nearly matches the significant growth rates of the supply of treasury securities. So this big disconnect is an important part of the story. When you have a massive increase in the treasury supply and a much more constrained intermediary sectors, it's going to be much more difficult to intermediate the treasury bonds, which result in the loss of convenience. So this chart is not from this paper, but from the existing literature, including some of my own prior work. What you see is that what happened, the GFC is quite a turning point, together with the increase in supply post-GFC and the more constrained intermediate balance sheet. What we have seen in the data is that the dealer's net position in treasury bonds has actually flipped side. So before the global financial crisis, dealers' overall net positions in these coupon treasury bonds, as plotted in the blue line, were negative. And post-crisis, they are net long treasuries. So they overall on net are holding treasuries in their long position. So what does that mean? If dealers are overall on net long treasuries, okay, so they're going long in the cash treasury securities, dealers want to hedge the duration risk on these treasury inventories. They need to short the duration either using swaps or futures. and therefore they are collecting the negative of the swap spread, right? If they're long treasury, they better make sure that the treasury yield is higher than the yield on the interest rate swap, and that corresponds to a negative swap spread. Whereas before the global financial crisis, when they were overall on net short treasuries, they would expect the swap spread to be yielding more than the yield on treasuries. Again, the sign of the swap spreads coinciding exactly with the switch in the dealer net position in treasuries. So this is another piece of evidence, even though it's not in this paper, that's fairly consistent with this notion that the dealer balance sheet constraint matters significantly because they are the marginal pricer of the swap spread, which is a significant driver of the treasury convenience measure. Okay. And this negative swap spread that we have experienced in the US is not universal phenomena. So this is plotting the average swap spread in our post-GFC sample. What you have seen is that the negative swap spread is particularly a problem for the US and UK if you take a post-GFC average, whereas for many parts of the G10 advanced economy with a lot more government scarcity, the swap spread on average has remained positive. So in other words, the government bond supply in the cross-section seems to be quite correlated with lower swap spreads. If you boost the supply of government bonds, that tend to dampen the swap spreads, whereas in countries such as Scandinavian, Sweden, Denmark, and Norway, without much government bond supply, the swap spread remains to be quite positive. Okay, so the role of supply can also be shown in the time series or in the panel regressions. So here we are just going to be running the US Treasury relative convenience measures on the relative supply of government bonds, both in the US and in the foreign countries, together with some additional controls such as VIX and additional solvent credit risk measure as proxied by the solvent CDS spreads. What you have seen here is that on the first two lines, the coefficients are in line with what you expect. So the relative convenience measure of US Treasury is going to be declining in the supply of US Treasury bond and is going to be increasing in the supply of foreign government bond. In terms of economic magnitude, so these are in the log of GDP. So if you double the debt to GDP, you're going to be associated in the US, that's going to be associated with around 50 basis point decline in the US Treasury premium. And if you double foreign government bond supply in terms of the foreign GDP, that's going to correspond to a 23 basis point increase in the US relative convenience of US Treasuries. So the effects of increased supply of US debt is a little bit larger based on these economic coefficient estimates. But qualitatively, you do get what you expect. Okay, so relative supply is an important part of the story, both in the panel, more time series dimension, and also I've shown you some of the swap spread charts. Also, there's some consistent evidence in the cross-section. Okay, so far the story I've been telling is not really unique to the Trump second administration. It's not unique to the reciprocal tariff announcements, but obviously since the so-called Liberation Day last year, there has been a lot more discussion about Sell America trade, about this, we are in a very different era. So I'm also going to dedicate a few minutes to discuss what has happened following the reciprocal tariff announcement, i.e. the Liberation Day. So this is a short event study which shows the price dynamics in both the US dollar convenience and the US Treasury convenience 1 week before and after the April 2025 Liberation Day. In short, the US Treasury convenience has declined in line with what's been covered in the press. But if you actually look at this particular measure of US dollar funding convenience, there has actually been a modest uptick. So despite the broad dollar depreciated quite considerably after the global financial crisis, after the Liberation Day, there appears to be some additional increase for the premium associated with getting access to US dollar funding. But on the other hand, the Treasury bonds across all maturities have experienced a continued decline in their specialness. And there's also a bit of cross-country evidence that's interesting. So this decline in the US Treasury convenience is not broad-based. It's particularly pronounced vis-a-vis countries with low level of government debt. So Japan is quite an outlier here, and so is UK a little bit. So in the countries with more higher level of debt, the decline of US Treasury specialness bilaterally vis-a-vis those countries after Liberation Day is not so pronounced. Okay, so I think I have 4 more minutes in this 45-minute prepared presentation part. So I'm just going to quickly comment on the conceptual framework that hopefully helps us connect all the distinct pieces of empirical results that we have discussed so far. I find it easy to think about the conceptual framework with a very, very stripped down version of a dealer model because I argue that dealer intermediary constraint is a key part of the story for both the US Treasury and the US dollar funding specialness. So I want us to imagine there is a global intermediary, this large global dealer that has 2 separate business lines. One is to lend dollars in the US money markets and FX swap markets, both borrowing and lending, and the other is to be an intermediary to hold US Treasury securities and finance the via repo. Okay, so we're going to assume that the Treasury repo financing rate is going to be slightly below or could be above the risk-free rate. And this wedge, I'm going to denote as the repo specialness. This delta superscript Treasury denotes the Treasury repo specialness. And just to help us with intuition, we can imagine the specialness to be decreasing in the supply of Treasury. So Treasury repo is special only if the Treasury collateral is not so abundant. It's more scarce. But if Treasury collateral is everywhere, then this repo specialness term is going to disappear. Okay. So if you have this model in mind, so dealers can either intermediate in the dollar funding markets, earning the FX swap implied CIP deviation or risk-free CIP deviation, that's one line of business, or they can use repo to finance treasuries and effectively earning the negative of the swap spread. That's the second business line. So what the dealer is going to be doing is to maximize the profits, the combined profits from these 2 business lines, subject to a consolidated balance sheet constraint that requires their overall activities with relative scales of the risk exposure or risk parameters associated with these activities to be less than their overall equities divided by a leverage constraint parameter lambda. Okay, so if you have this simple framework in mind, then you're going to understand that the US dollar specialness measure, our X superscript RF, is simply going to be capturing the shadow cost on this balance sheet constraint, which is denoted by mu. So this, mu is the Lagrange multiplier on the shadow cost of this leverage constraint. Okay, and what is the Treasury specialness measure, or our swap spread measure in this case? The swap spread measure is also going to be capturing the same shadow cost on the balance sheet constraint, potentially with a slightly different parameters for the risk-weighted or non-risk-weighted constraints in front of the Treasury intermediation activities. Okay, so the shadow cost on balance sheet constraint has to be equalized across these 2 business lines, which is going to show up as how much dealers are going to be earning in the repo and in the FX swaps or intermediate dollar and the intermediate Treasury business. Okay, so if you set up these 2 first order conditions, what you can show is that the Treasury convenience can be summarized as the last equation on the slides as the relative convenience measures of collateral specialness in the US and in the foreign countries and additional terms that is a function of the US dollar specialness. So the key insights in this case is to think about the most simple case. If the balance sheet constraint for intermediating dollar funding and for intermediating Treasury security is equalized, so these 2 alphas or A's in the leverage constraints are completely identical, then this term actually drops out. So in other words, in the most stripped down version of this framework, balance sheet constraint should not directly affect the Treasury relative convenience measure because the negative swap spread is going to be exactly offset by this positive additional boost on the US dollar convenience. And in the simple version, the Treasury convenience is largely driven by the relative supply of government bonds in the US in the foreign countries, as what we have seen in the pre-GFC world, where the relative supply does matter, even in the absence of significant balance sheet constraint. However, if you have a story that the balance sheet cost of intermediating Treasury is going to be higher than intermediating dollar funding, then you can have the intermediation constraint associated in the post-crisis balance sheet constraint world is going to act as additional negative drag for the Treasury inconvenience. Okay, so I think I'm just going to conclude and look forward to the discussion that we're going to have. What we have shown here is a couple of key highlighted facts. In particular, the Treasury and dollar convenience have diverged significantly in their international comparison. Treasuries have lost their convenience where dollar has remained convenient, and we believe the relative bond supply in the US and the foreign country is a key driver. But the last bullet point is also quite important to keep in mind. Perhaps one manifestation of the Treasury specialness is, in fact, the sheer amount of volume of debt that the US has been able to issue before we reach this point of marginal inconvenience. Okay, so I'll just stop here. Look forward to our discussions.
Wenxin, thanks very much for this very clear presentation. So, and I look forward to giving the floor to the first discussant, and that's Andreas. So, Andreas, you have been involved very actively in financial market research, and many of the topics that have been raised by Wenxin are also on the BIS's agenda, no, for quite some time. So, what would be your views on her analysis?
Yes, thank you very much for having me to discuss this work by Wenxin and her co-authors. It's really been a pleasure to read this paper and to engage with it. Also, I mean, it's really very well timed. So, you know, some of the issues that the authors wrote in the early version of the paper, they became even more relevant with time. So it's really a very well timed paper. In my discussion, so I thought I divided up first by starting out with a little bit of backdrop to put the paper into perspective, exactly, you know, referring to some of the recent developments and main debates out there. Then I felt I do a little bit of a history of thought discussion on convenience yields, you know, and where that comes from, giving a brief recap of the paper. Then I'm going to turn to 4 specific comments that I had when reading the paper. And then, you know, towards the end, I'm going to wrap up with a bit of food for thought. And in particular, the main question about, you know, as the inconvenience of the US Treasury market grows, you know, what are some of the substitutes? Where is what are the new safe havens, basically, so to speak? In terms of backdrop, I think the paper really speaks to 3 main current debates out there at the moment. One that was mentioned already by Martin at the beginning is this question of what happens to dollar dominance, the exorbitant privilege that the US has come to enjoy is being more actively contested. That's been heavily discussed in some of the practitioner circles as well. And it also, of course, has a geopolitical dimension to it. And just to basically illustrate this, here I've taken some exhibit from a quarterly review article that my colleagues Frédéric Boisset and Wenxin Wang wrote in September 2025. So this looks at the shifts in correlation post Liberation Day in the US Treasury and in bonds. And it kind of shows us what Wenxin also alluded to, that the Treasury market hedging properties, the correlations with other safe assets have shrunk noticeably. If we compare that to the benchmark of you know, how these correlations on average were now here in the blue dots between 2000 and 2025 March, before the Liberation Day. To the right, you see for bonds, that's another potential safe asset here. We actually saw correlations with gold going up and correlations with the VIX actually going slightly up. So we don't seem to have seen maybe such a deterioration in this short-lived episode, arguably, that we're looking at here. But yeah, so this is a key backdrop to the paper. The other key areas that the paper speaks to are issues around Treasury market functioning. Wenxin noted the constraints on dealer balance sheet capacity. They've come to the fore in March 2020, but also in the Liberation Day episode, there were episodes. There was periods when deleveraging took place, and before the U-turn took place when it comes to tariffs. There were episodes when things looked a bit wobbly, quite a bit wobbly in the markets, to say the least. And then finally, the other debate the paper speaks to is the post-LIBOR world, the adoption of new benchmark rates, which arguably has led to somewhat more fragmented landscape in term rates. And the paper really helps us there to navigate this and gives us a new measurement on how we should think about cross-currency basis in this more complex world of new reference rates. In terms of further backdrop, the term convenience yield comes up a lot nowadays in the academic literature, but also in policymaker speeches. And so I thought I give you my preferred definition, which I basically have put here on this slide in red. So it essentially embodies the implicit return from holding a quasi-riskless asset and for its non-pecuniary services. So safety, liquidity, and collateral pledgeability. These are some of the things that we commonly associate with US Treasuries as being the prime collateral asset, so to speak, in the financial system. And however, it's relatively new that this concept has been applied to the Treasury market. The old concept of convenience yield is much earlier. I mean, it comes from the commodities literature. The Calder in particular, the work on the non-pecuniary returns to storing the physical inventory. But that literature didn't really produce a lot of analysis. In fact, we have now seen much more of an explosion of work as the convenience yield work has been adopted in the fixed income literature, first with Longstaff, then later Krishnamurthy and Lissing-Jurgensen in their seminal paper in 2012, which then made it really standard and mainstream to use in the fixed income literature. And then Wenxin and her co-authors took this a step further in 2018 to extend it to the cross-currency perspective. Now, Wenxin already gave a very good summary of what the paper does, so I'm going to be very brief here. It has these two notions of US dollar and US Treasury convenience, which are effectively CRP deviations at different parts of the yield curve. So one for short-term rates, so SOFR versus local risk-free rates in other currencies, and then longer term for government bond yields. And related also to what I said about this dollar discussion, dollar debate, what the paper does is it disentangles what happens to the currency, the short end, from what happens to the long end. So I think that's really the main contribution. And it shows us that there has been such a decoupling taking place between the convenience at the short and the long end. Now regarding my comments, so Wenxin showed it already. There's a key equation in the paper, equation 6, and when you rearrange that, effectively you end up with the difference in the two convenience measures, the Treasury and the dollar convenience measure, as being effectively the difference between the swap spread in the US and the foreign swap spread. And so ultimately, when we're thinking about the decoupling, it's really important to understand these relative movements in swap spreads. And it is very right that in particular, since a while now, the longer-term Treasury swap spreads have fallen into negative territory. As I'm going to show you in the next slide, foreign swap spreads have quite lately, and also after some of the sample in the paper, also compressed a lot and have become negative in some cases. And that warrants, I think, also a bit of a greater discussion, maybe also as the authors augment the sample period. I think very much the same mechanisms are going to be at play here. The second point on relative swap spread is that there is, of course, an aspect related to asset safety and supply, which I believe is truly an important factor to explain the relative swap spread developments. But there's also work that's emphasized pressure that influences the swap lag itself. So, which I feel could be discussed a bit more in the paper. For example, Klingler and Sundarasan, they highlight the demand for swaps by pension funds that are underfunded. German emphasizes also dealer balance sheet constraints, but more on the swap leg side in his work. These are just a few examples that it's also worth thinking of what drives the swap leg in these instances. And then when it comes to the testing, I felt that it would be good to have a bit more complementary evidence as well, with cross-checks on domestic measures that are more in the spirit perhaps of Krishnamurthy Vissing-Jurgensen originally, some of the checks that are done in one of Viral Acharya's latest pieces. And then really to me, what would really be super interesting is to see if we see something in the collateral markets, if we're seeing shifts in repo haircuts or margin requirements, depending on different types of assets. I think that would really be super interesting evidence that could complement what Wenxin showed us. Now, regarding the second comment, this is just basically referring to the foreign swap spreads. There are a lot of idiosyncratic features that happen in different markets. So, for example, in Denmark, Sweden, Great Britain, you have quite a lot of LDI factors that influence, in particular, the swap leg of these swap spreads. Then in the euro area, Japan, there were always concerns about asset scarcity, given the large-scale asset purchases. But I think what's quite interesting is that, when we're looking at an average foreign 10-year swap spread, this is basically an average across the G10 currencies, that has also now compressed quite a lot, and partly, it has accelerated after the authors wrote the paper. And when you're taking a look at the like a simple principal component analysis, there's really been a common factor that's quite strong more lately, and it might have to do with a difficulty of absorbing supply. So which I think I think broadly corroborates actually the story in the paper, as basically we had a synchronized retreat from large balance sheets by major central banks. Now, the third comment relates to the macro regime. The paper focuses a lot on the debt supply, which I think definitely makes a lot of sense, and I fully believe that that's important. It's just that there's also other important shifts in the macro regime that I think need to be considered or maybe controlled for, and that's the shift in the stock-bond correlation, which ultimately owes to shifts in the demand versus supply-driven nature of the inflation process, I think. So it's worth looking at the work of Caroline Pflüger and Anna Cieslak in this regard, which points to these underlying deep macro factors. And so the question is, or what I think the authors should ideally do, is to verify that the results on the asset safety are not somehow confounded by shifts in convenience that might have to do with the macro regime, for example, because some currency areas have been hit more by supply shocks versus demand shocks than other currency areas. So I think that would be worth to investigate, not least because there is this work by Viral Acharya and his co-author that emphasizes the shift in the stock-bond correlation to explain the shift in convenience yields. The fourth comment is about marginal buyers along the term structure. It would be great to get a sense because there's been quite a lot of changes in this regard. We know that foreign central banks, which are quite price inelastic buyers, they have withdrawn or are no longer accumulating treasuries so much, relatively speaking, whereas we have seen a shift towards more price sensitive players. So it would be interesting to explore how that plays out along the term structure. But then there are also aspects around debt management that have changed. In particular, there's been a much greater supply of treasury bills and short-dated bonds. And how that interplay influences the convenience yield findings that you have would be very interesting. And finally, there are stable coins. That's the other really interesting development that has influenced the market dynamics, as my colleague Iñaki Aldasoro and another author, Ahmed, have shown. And so it could be that basically, because of high demand for stable coins, we could get this disconnect, where we have dollar convenience actually still holding up very strongly versus US Treasury longer dated securities being less convenient. And I think that would be interesting to explore. Maybe not in this work, but in future work. Yeah, finally, really, it's just a question on where, as we see this decline in convenience yields, it's always a relative statement. So what is it then which sees an increase in demand and that becomes more convenient? Is it gold? Is it bonds? Is it stable coins? I think a bit more of a discussion or analysis of that would be great. And I should not take much more time because we also want to hear the other discussion. Let me just say that this is a great paper. It's on an important and timely question. I should really say that the measurement is an important public service. So the fact that you provide these cross-currency bases in the post-LIBOR world is very important, and it stimulates a lot of thinking. And yeah, looking forward to the paper in the next version. Thank you very much.
Thanks very much, Andreas. And now we can go to the second discussant, and that's Zornitsa. I think you dialed in via phone. Yes. So you lead research work as a major dealer bank, and that's also highly active in bond and FX markets. So you bring a very different perspective, and we would be really keen to hear your views about the paper and the analysis. Please, the floor is yours.
Thank you so much. Can I please quickly check whether you can hear me all right? Because
yes, we can hear you, and we can also see your slides. Thanks.
Yeah. Thank you so much. I just wanted to quickly apologize about me dialing in via phone. It's just that my Barclays IT system has decided to block the WebEx link as highly suspicious, and trust me, the irony of that is not lost upon me. And so I want to apologize again for hiding behind this very weird name calling user, but I'm glad we're able to make it. I would just like to hover a bit on the title slide here, and I just want to say that this is genuinely an excellent paper, both conceptually and empirically. I found it extremely insightful. I think it tackles a foundational assumption in international finance with a very clean and a very rigorous framework, and in doing so, it brings together several strands of the literature in a way that feels both convincing and highly relevant for markets. I learned a great deal from the paper, particularly in how it reframes the relationships between the dollar dominance and treasury specialness, and how it links these dynamics to market structure and balancing constraints. So congratulations to the authors for an extremely impressive body of work. Now, if we can go to slide 2, please. I'll just give you my take of the paper from a practitioner's point of view, and I would say that the paper starting point is very straightforward but incredibly powerful. It uses market implied pricing to extract measures of convenience yields. In other words, how much investors, like the ones that we're servicing at Barclays, are willing to pay to hold safe liquid dollar assets and US Treasuries. And I think this provides a very clean, price-based way of quantifying specialness, and it also allows us to make a direct comparison across currencies and across sovereign bond markets over time. The key finding is a clear decoupling between the two. The US dollar continues to command a persistent convenience yield, which reflects its central role in global trade, funding, hedging. Treasuries, by contrast, no longer exhibit the same premium. And on a like-for-like basis, their relative convenience has declined materially and is now negative versus peers across much of the curve. So in other words, the dollar remains structurally scarce, but treasuries are no longer structurally rich. What makes this particularly striking is how it shows up in stress. The dollar still behaves as a classic safe haven, strengthening when risk rises, but treasuries increasingly do not. And in recent episodes, they have underperformed in risk-off environments, particularly at longer maturities. So the traditional safe asset bundle is breaking apart. The currency retains its safe haven role, but the bond does not in the same unconditional way anymore. If we move to slide 3, please. So to me, the key takeaway is best framed as de-dollarization, but with a twist. And I found this really, really interesting and very powerful. So this is not happening at the currency level, but at the asset level, which again, I thought was a brilliant way of contributing really a novel perspective to a debate that is particularly pertinent for us in the industry. So the paper speaks directly to that debate and its implications to financial plumbing. But what it documents is not a retreat from the dollar itself. Instead, it points to a shift at the asset level. So the global system still runs on dollars for trade, for funding, for hedging, and that demand remains firmly intact. So, but what is changing is the role of treasuries within that system. The US still supplies the world's currency, but it no longer provides the uncontested safe asset that sits behind it. And again, I thought that this was a very, very neat way to speak to that debate, and it really resonated with everything that we're seeing in markets and all the challenges that institutional clients have nowadays. Moving on to slide 4, the key takeaway is that dollar strength and treasury weakness are being driven by very different forces, with regulation amplifying the gap. Again, taking a seat on the industry side, regulation is something that I'm definitely very sympathetic to, and its impacts on our financial market systems. So on the one hand, dollar demand is fundamentally structural. The global financial system still runs on dollars, again, for trade, for funding, for hedging, but that creates a persistent need for dollar liquidity. And I think we saw this very clearly in March 2020. In this dash for cash, when global investors really scrambled for USD funding, sending the FS basis sharply wider as dollar liquidity became scarce and expensive. And in the rush, even US Treasury sold off as investors liquidated what they could, basically. And so the message was clear: in stressed markets weren't simply seeking safe assets, they were chasing cash dollars. On the other hand, the paper frames treasury weakness as largely a supply story. The sharp increase in US debt issuance since the global financial crisis has diluted perhaps scarcity, and the paper shows a clear empirical link between higher supply and lower specialness. And crucially, this is relative. What matters is US supply versus the rest of the world, and not just the supply in absolute terms. And on top of that, regulation amplifies this divergence. Tighter post-global financial crisis balance sheet constraints mean that banks prioritize dollar intermediation, which is profitable and in demand, while stepping back from Treasury arbitrage. The result is a system where dollar convenience remains high, but Treasury convenience has structurally eroded. I'd like to spend a bit more time on the next slide and share some high-level thoughts from a practitioner's point of view. So I think from my side, I think the paper has two main implications. I mean, to be fair, it has many implications for the industry as a whole, but just two really resonated with me. So first, the paper's core takeaway is that once you put assets on a like-for-like basis, same currency, same hedging, treasuries are no longer obviously the best deal. And what this means that basically investors can now replicate the treasury-like exposure by buying foreign government bonds and swapping the FX risk back into dollars. And that creates a synthetic treasury. And crucially, the trade can now go the other way, and with hedged foreign bonds offering perhaps a better return than US Treasuries. And what's really changed in this is the market plumbing. We have deep liquid FX swap markets and standardized clear derivatives that have made it really easy to scale these trades. While on the other hand, post-GFC regulation has made it more balance sheet efficient to create synthetic dollar exposures than to warehouse cash treasuries. And so I would say that for rates RV desk, relative value desks, that opens consistent cross-currency and swap spread opportunities. For macro allocators, it turns safe assets into a global relative value trade rather than a default allocation into US bonds. The second key point, which I am covering on slide 6, is that, if we can move on to this slide, please, is that treasuries are no longer automatically top of the collateral stack. We've seen this in practice again. March 2020, even treasuries were sold aggressively as balance sheets sailed up. For years now, swap spreads have been negative, which implies that treasuries trade cheaper derivatives. And Ripple specialness has become more, how should I say, more episodic rather than structural. And so at the same time, investors increasingly use foreign government bonds and swap them into dollars. And so that's kind of effectively globalizing the collateral pool. And the result is a system where collateral valuation is more relative and flow driven. It's not just hard coded, if that makes sense, where balance sheet and not just asset quality determines what is truly special. If we can just move on to slide 7, please. I think one way to think about the results is to question what we are actually measuring. The paper uses CAP deviations as a proxy for convenience yield, but in practice, those deviations embed a lot more than just specialness. For example, they could reflect funding stress, regulatory costs, and just broader market frictions. So part of the apparent decoupling might not be treasuries losing appeal per se, but rather the rising cost of intermediation showing up in prices. So I think this is something that is worth discussing a little bit more. A second point is perhaps around demand. So treasury demand is not homogeneous. Banks, LDI investors, and reserve managers all have very different constraints and incentives. So for example, banks still need treasuries for HQLA, and central banks value depth and scalability. So what I'm trying to say is that treasuries may still be structurally special for core holders, even if they no longer command a premium at the margin in market pricing. And finally, the synthetic replication story works cleanly in normal times, but it is much less robust in stress. And so it implicitly assumes that FX hedging is frictionless and that basis market scales smoothly. In reality, we know that the opposite might happen. The FX basis can blow out and hedging costs can surge precisely when investors care the most about safety. So I guess the point I'm trying to make is that synthetic treasuries are suitable in calm markets, but not fully so in crisis. And just finally on slide 8, just let me highlight a few areas where I think the paper opens up further discussion. And I just want to emphasize that these are less criticisms and more extensions that could help refine the interpretation of the results and add a bit more useful nuance. In particular, I think there are 3 areas where the findings could be a bit further contextualized, and which, in my view, also point to interesting avenues for future work. So first, number one, I think I think I realize that I'm running a little bit out of time, but I'll just quickly summarize again. I think first we need to be very careful about what we're measuring. Second point that I talked about earlier was also around demand, and finally think about the synthetic replication. But I'll pause here, and first of all, I want to apologize again to the authors for not being able to join with video. I give myself bested by IT and technology today, and I want to congratulate once again for what I thought was an extremely insightful paper that speaks to so many different avenues of research, and that I thought was very, very relevant from an industry point of view. And I'm looking forward to reading further versions and iterations of this paper, and good luck with finding a very suitable home for this paper. It was a pleasure reading it and discussing it to the best of my ability. Thank you so much.
Thank you very much, Zornitsa, and we could hear you very well, so don't worry about.
I'm so glad. I'm so glad.
Yeah. Okay. So we have a little bit less than 15 minutes left. So why don't I give the floor again to the author just to reply, and then we could maybe take a few of the questions in the chat also. So, but I give the floor back to you, Wenxin, first.
Thank you so much for both discussions. Both were fantastic. Yeah, so many points are very well taken. I'm just going to select a couple of things to say a few words. This is by no means exhaustive. Like everything is super well taken, and we will think more about it. The first thing I want to say is in terms of the measurements, I completely agree. The CIP-based measures are just a proxy, right? We use the word convenience, also going back to Andrea. This is like a very broad catch-all phrase. It's not super specific about safety premium, collateral premium, market segmentations, like any additional specific supply-demand episodes. But we do want to highlight, like, what has been true is that this pattern, right, about declining this quote-unquote convenience is very broad-based, and it's quite persistent, which suggests it cannot be something that's just temporary, right? There has to be some structural differences. And among all the drivers, I do think supply and increased dealer balance sheet constraint post-GFC are the two most structural things, and therefore have the better odds of explaining this deep structural change. If you don't want to get involved with all these derivative-based frictions, again, I completely agree. FX derivative markets and interest rate derivative markets are not perfect. You can also do an alternative measure, which is just to compare the US Treasury with AAA-rated supranational bonds denominated in dollars. So for that, you're doing a cash bond versus another cash bond comparison. And that, interestingly, there's actually a recent Bloomberg article that also shows like a similar decline in the sense the US Treasury yields are increasingly higher relative to AAA-rated supranationals, and the spreads may have even flipped sign recently. So there are sort of other signals that point to the same broad finding. But yes, one shouldn't be caught up on the specific basis points, because I completely agree that can be very much driven by the other factors. Yeah, so I think I'll just leave that as a broad comment, and perhaps I can take a few other specific comments from the audience.
Thank you very much. So there's a lot written in the chat. So maybe I try to summarize them very quickly. So there's one question about what's going to happen now, no? So for instance, also other countries are expanding their public debt, and for instance, related to COVID, no, or defense spending. So do you expect a similar specialness also for these other currencies? Then there's a question on the Fed policy. So with Warsh now being appointed, who has very frankly said that his idea is to scale down the Fed balance sheet. So what do you see are implications from that? And more generally, what are implications for investors now in terms of their portfolio composition? So then other questions. So can we say that the CPI deviations at the short end would measure US dollar specialness? And so how do we interpret that? And even the sign of these CPI deviations, they vary over time. And then maybe a last one, the swap spreads. One commentator interprets them as, from your paper, as the result of the post-crisis reforms. Can you confirm that? And doesn't that mean that if we reverse the reforms or reform again, that this can be reversed? Maybe I stop here because we have only so few minutes left.
I'm trying to keep track in my mind, but please remind me if I'm missing some key questions. So I will start perhaps on what happens if foreign countries are also scaling up their government bond supply. So as we discussed, right, this measure is a relative measure. So if foreigners are also supplying more, that's going to look the US relatively more special in the Treasury front. So it's a relative measure. And we do see, as Andrea was discussing, right, more recently, especially in Euro area, like we have a lot more news on fiscal expansion, and that does show up in a more negative or just declining swap spreads in Euro area, which in terms of the measurements of the US Treasury vis-a-vis the Euro area government bonds or German bond in particular, it's going to put it more in favor of US Treasury relative specialness. And also, in addition to this fiscal expansion, additional government bond supply, there's also the QT running in the background, right? Quantitative tightening. So we have another paper that looks at the cross-country experience of QT. And for that, we also show pretty, I think, clear empirical evidence that QT is associated with worsening of the swap spreads very intuitively, because QT is the central banks are not holding as much of duration or a government bond supply, and that's somewhat similar to an increase in the government bond supply relative to the market participants outside the central banks. So countries that are running more aggressive QT programs, such as the UK, which involves active sales of securities as opposed to passive runoff, is also going to be hit more on that metric. So that also connects to the question about when the new Fed chair, Kevin Warsh, if he wants to shrink the Fed balance sheet, what is going to happen to the US Treasury specialness or dollar funding specialness? I think there can be a few implications. The first is the more direct QT analogy, right? We think about if the Fed significantly cut its existing holding of Treasury, that's going to be similar to releasing that additional supply into the market. It's going to make the US Treasury less special on the international comparison and increase the cost of US borrowing if you use this counterfactual cost that the other foreign countries are paying on a synthetic dollar basis as the benchmark. On the other hand, by shrinking the balance sheet, as we know from other work, that's also likely translating into a lower balance of reserve balances for the banking system. So that might negatively, depending on the scale, depending on the implementation and all the other things that are happening in the same time, let's say other things being equal, if you just merely shrink the Fed balance sheet, that reduces the overall checking account balance or reserve balances to the banking system at the Federal Reserve. And that can be quite a problem because that would impede the overall well-functioning of the short-term funding markets, which is the key to financing additional treasuries. So as we know, which we didn't discuss that much on the margin, right? This is a pretty strong statement, but I think the practitioners on the call will agree. On the margin, the US Treasury bond is financed by a levered investor using a high level of leverage. And most notably, we're talking about the relative value-based hedge funds domiciled in Cayman Islands. So if you and all this leverage is essentially funded with very, very short-term basis, like even like rolling over overnight repo or just repo for a couple of days. So any hiccup in the short-term funding markets as a result of the Fed balance sheet normalization or aggressive Fed balance sheet normalization is going to potentially shake this massive leverage-funded relative value trades, which has been absorbing a huge chunk of the US Treasury on the margin. So beyond this overall level shifts that making the US Treasury less convenient, super aggressive balance sheet policy may destabilize the overall stability of the Treasury market because of the massive amount of leverage that's involved at the tail. Okay. So okay, so then so that was that, and then we had discussion about the swap spread is a key part of the story. I completely agree, and I showed you from other work, right? What we have seen is a changing sign in the swap spread with the GFC 0809 be the turning point, and in the meanwhile we have a change in the dealers' positions. So so if you think about the swap spread comparison, the bond is the cash instrument that shows up on balance sheet, and the interest rate swap is the derivative that's largely showing up off balance sheet. So a big part of the story, I agree, is the balance sheet treatment difference between the cash security versus the interest rate swaps. So if you have additional changes on the regulation side in terms of the treatments of that cash security, right? You can think of dealers are optimizing on the margin, equalizing the balance sheet cost, encoding these securities. So that can be a driver in changing the direction of the swap spread. But that's not all the story, because what we have seen is that every single major jurisdiction is subject more or less to the same Basel III level of capital regulations, but the swap spread is not uniform, right? So there is a lot of cross-country heterogeneity in the swap spread, and we talk about in Norway, in Denmark, in Sweden, the swap spreads are still fairly positive. So it's the interaction between a more tighter balance sheet constraints on holding the bond and a lot of bond that need to be cleared and intermediated by the dealer sector. So these two combination of forces led to a fundamental change in the direction and the dynamics of the swap spread. If you just have bank regulation but very low supply of bond, you're still in the old world when the swap spread is quite positive. So the US and UK, we have this combination of things so that the swap spread is increasingly negative. Yeah, so are there other new questions, or maybe I missed a couple of things?
So I thought maybe because I see Andreas also nodding and shaking his head in the background, so maybe we could use the last 3 minutes also for the two discussants to express their view on these topics if they want to. Andreas, you first.
Well, yeah, I mean, I think when Wenxin gave a super comprehensive response to a lot of the points, maybe just a few complementary ones. You know, on the scale of the balance sheet and with the new Fed chair and wind down. I mean, I would basically say that revealed preference by central banks is that any balance sheet wind downs take place over a long period of time, usually. So this is the typical watch the paint dry analogy. So, and I think they would also take into account market functioning considerations. And then I think it would also probably not happen in a vacuum, because the maturity composition of the government debt is a key factor as well, and what Treasury will do to basically replace some of the securities and so on, that's going to be important too. And I think that relates perhaps to my point as well on new demand being found via stable coins, in fact, or some similar type of instruments, which would have to be factored in as well. Then there was a question, I think, on the on regulation. No, so I mean, would it be that we would be better off if the dealers were just less constrained? Well, I would just put a word of caution there, because as Wenxin noted, when the dealers absorb this issuance, they're effectively earning the swap spread. So they're going to ramp up their holdings of securities, but in essence, they will have to engage in associated derivatives transactions to hedge out the interest rate risk. They're going to have to fund the purchase of the security by the repo. All that needs to be rolled over. It is a highly, leverage intensive activity. And we have known from the GFC episode, that this type of leverage creates negative externalities. And if the system is maxed out in this way through so much leverage, it cannot flexibly, elastically expand anymore when it's already maxed out. So I would therefore put a word of caution on the regulation point.
Thanks very much. So also from my side, then many thanks to the author, Wenxin, the two discussants, Andreas and Zornitsa, and of course to SUERF and Martin for organizing this. I completely agree. It's a fascinating paper. It was great to listen to this. And there's a number of comments in the chat. I see that they will be saved, so you can take a calmer look at this, Wenxin, and take it from there. So thanks very much to everyone.
Thank you so much. That was a pleasure to present. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Bye.